What's going on, guys? Welcome back to another video, and well done to you if you are a holder of Snap stock, because they reported earnings on Friday and they saw a 24% increase in their share price in one day, which is absolutely phenomenal. So well done to you if you are a holder, but I thought that today we would go through their earnings report and see if this jump in share price is actually warranted, and we'll see what their fair value of the company is. So first of all, we'll go through their earnings report, and then I'll go through my personal valuation for the company and see whether I'll be buying the stock or not. So just before we get onto that, I just wanted to flick over to Twitter's share price, because they also reported earnings, decent earnings, but not enough that we saw a 24% rise in their share price. So they were only up 3% on the day. And then we've got Facebook stock, whose share price went up by 5%. Now, they didn't actually report earnings, but what investors are doing here is that they are seeing this pattern that all of these different social media companies are reporting far better earnings than what were expected. And so we're seeing a huge rise in share prices. So now Facebook is at $370, which is an all-time high for them. Similarly with Google, they're absolutely crushing it as well. They were up 3.5%. Again, Google's sort of business model is slightly different, but they do rely on advertising, so that's why they've shot up as well. So anyway, let's get into Snap's earnings. So literally right here, we've got the first sentence within the earnings report. Revenue increased 116% year on year to reach $982 million in Q2 2021. Now that is absolutely phenomenal growth. 116% year over year growth is astounding. So straight away, it's not that surprising that we've seen a massive jump in their share price. So we can see here that their average revenue per user increased 76% year on year to reach $3.35, which is very good, but that also shows that not only are they growing their user base, but they're also growing the amount of revenue which they're earning from each user. So that's very positive. Operating margin improved to a negative 20% in Q2 2021, compared to negative 68%. So they're still loss making, but those losses are contracting, which is good to see as well. Adjusted gross margin improved to 55% in Q2 2021 compared to 47% in Q2 2020. So Snapchat's gross margins aren't actually that impressive for the type of business that they are. So 55% isn't actually that great, but what we are seeing is now we're seeing the growth in their gross margins, and I expect that to continue to increase, probably right the way up to sort of 75 or 80% gross margins. And that's what we'll see in my valuation a little bit later on. So we can see here as well that net losses also improved by $174 million year on year, which is actually absolutely huge, but they're still making losses of $152 million in this quarter. So they're not profitable, and I don't think they'll be profitable for at least a few more years yet, and we'll see that again in my valuation model. But yeah, definitely we're seeing good signs that the tide is starting to turn for this company. Now, their free cash flow was actually a negative $116 million in Q2 2021 compared to a negative $82 million in the year prior. So that's not a good sign. We'd hope that their free cash flows were actually improving, but we can see here that they're actually worsening. And then I think also when we go back to Q1 2021, they were actually free cash flow positive. So for them to then turn negative again isn't necessarily a good sign, and we'll have to dig into why that is later on. A really big positive here, though, is that their ending cash equivalents, and marketable securities were $3.5 billion at the end of the quarter. And I think that compares with debt of around $2.9 million. So they've got sufficient liquidity. Their balance sheet is actually really good. And actually, we'll just jump over to the balance sheet now to take a look. So as it said in the presentation there, we can see that they've got cash and cash equivalents of $2 billion, and then they've got marketable securities of $1.5 billion, and total current assets of $4.5 billion. When we compare that with total current liabilities, it's only $750 million. So very, very good. I think that's a current ratio of about 6. So that's very impressive. And then on a total assets basis, they've got $7 billion in total assets, and total liabilities, they've got $4 billion. So their balance sheet is actually very, very good for a company that is loss making. So that's all good there. There's no chance, I don't think, of them having to raise a significant amount of cash anytime soon. They are still issuing shares pretty much year on year, but that's to be expected with a company that's growing quite a lot. But I don't think it's too dilutive that it would be a massive concern to somebody that's purchasing shares in this company. Now, in terms of the main business highlights, I think one of the most important, if not the most important, is their daily active users, and that's what we see first. So their daily active users were 293 million in Q2 2021, which is an increase of 55% or 23% year over year. So To me, I'm actually quite surprised by this. I didn't think that Snapchat was still growing at such a rate, but we can see here that actually their daily active users are increasing a lot. And it's important that Snapchat are able to capture users every single day, and that way they can earn as much revenue as possible. So monthly active users actually wouldn't be a very good metric to use for Snapchat, because we want people logging into the platform every single day or as much as possible, because that way you can earn a maximal amount of profit or revenues. And if we actually look at the breakdown or the composition of the total daily active users, we can see on a global level there was the 23% increase which they referred to, that's year over year. North America though was only growing by 6%, but when we look at the rest of the world, which is obviously their biggest market, the market that they haven't tapped into much yet, they've seen a 55% increase. So if they can continue that growth within the rest of the world region, then they're definitely going to grow very good. And I think that actually this is one of the key indicators that Snapchat is still continuing to grow at a rapid rate. And then for the average revenue per user, or the ARPU, we can see that the growth was 76% from $1.91 to $3.35. So that's very good. North America's grew massively, up to $7.37, but the rest of the world, look how much that is lagging behind. So they're only making $1 per user for the rest of the world region, compared to $7 per user for the North America region. Now, if Snapchat are somehow able to increase the amount of revenue that they get from their rest of the world region up to somewhere close to even $7, even if it was $4 or $5, then the growth in revenue will be absolutely huge. So that's something that they need to work towards, and that's something as an investor you need to be looking out for. So in terms of their margin, so earlier on I said that Snapchat currently have a fairly low gross margin, but I think that they'll be able to increase those gross margins somewhere up to 75 or 80%. And they're on track to do that. So we can see here that their adjusted cost of revenue as a percentage of revenue has decreased by 9 percentage points in a year, which is very, very good. And I fully expect Snapchat to continue on that trajectory, increasing their gross margins, just because of the type of business that it is. So once you've sort of laid the foundations, it doesn't cost that much to sort of provide the service to new users, and that's why as your revenues increase, your sort of costs of revenue actually increase by a smaller amount, which leads to that margin expansion. And just bear in mind that when we come to my valuation model, I'll be considering what I think that the gross margins are going to be. I'll be considering what I think the operating expenses as a percentage of revenue will be. So these slides are actually really important. But we can see here that in Q1 2020, for operating expenses as a percentage of revenue, they went from 64% all the way down to 44% in Q2 2021. So it's very promising that we're seeing that sort of increase in margins, and I think that in a few years' time that's how they're going to become profitable. And then just coming back to what I was saying earlier regarding the number of shares that the company has, so we can see that they're actually not issuing shares at a massive rate, and that's because their balance sheet is actually really good. So the year-on-year change is only 4% in Q2 2021 compared to the year prior. So 4% increase in total number of shares is not much at all for a company that is growing its revenues and its margins at this rate. So definitely very good to have a company that has such a solid balance sheet. So then that brings us on to the valuation model, where we use the discounted cash flow and earnings multiple model to try and come up with the intrinsic value for the company. But just before we come on to that, actually, I just want us to look at what their stock price has shown over the last year. So they've seen a 241% increase in just a year's time, which is absolutely phenomenal. And whenever you see a company that has a run up like that within a year, you always have to be somewhat wary of a potential pullback. So just bear that in mind, but we'll move on to the valuation model. Anyway, let's look at the valuation, right? So we've got 1 to 5 year revenue growth. Now I'm using 40%, which I think is probably quite generous. But I think that they've proven over time that they can grow their revenues at a significant rate. And I think that 40% for the next 5 years is probably about right. For 6 to 10 year revenue growth, I've gone for 20%, just because as the company gets larger, they're going to find it harder to grow at the same rate. So 6 to 10 year revenue growth of 20% is still a good rate of growth, and I think that's probably fair. The only exception to this revenue growth though is for 2021, because we've already got 2 lots of results already, so we're already halfway through the year, and analysts are expecting revenue growth of around 54% for 2021, so I've input that into my valuation. But other than that, everything else has been consistent at 40% and then 20% growth. And actually, if we just look at their revenue growth over the last 5 years, so we saw 104% growth, 43% growth, 45% growth, 46% growth. So they're always growing at around 45% a year. And I've used 40% year over year for the next 5 years. Now for their gross margins, we can see that they went from negative 12% in 2016 through to 13%, then 32%, and 48%, and 53%. So it's clear that we're seeing a trend here, right, of an increase in gross margins. And so what I've done is I've applied 55% gross margins in 2021 because that's what analysts are expecting. And then I'm expecting a 5% growth in their gross margins in 2022, up to 60%, and then 65%, 68%, 71%, all the way up to 76% gross margins by the time we hit 2027. So I think that's reasonable when we compare it to other similar businesses. Their gross margins are somewhere between 70 and 80%. And I think that's what Snapchat or Snap will actually grow into. And I think that my valuation model quite nicely incorporates that as well. So for operating expenses, we can see here that the average of the last 5 years was 178%. Now, obviously, I'm not going to include that in my forecast going forward because, as I alluded to earlier, they are expanding their margins and becoming more and more profitable, or less and less loss-making. But in 2020, their operating expenses as a percentage of revenue was 87%. In 2021, analysts are expecting around 80%. And then effectively what I've done is I've decreased their operating expenses as a percentage of revenue until we get down to 40%, at which point I'm expecting these sort of margins to plateau, and that's in 2027. And then similarly for free cash flow as a percentage of revenue, so we can see here that they were, on average for the last 5 years, they've been at negative 73%. But if we look at the trend, in 2016, it was negative 168%. In 2020, it was negative 9%. And so they're very, very close to becoming free cash flow positive. So then in my forecast for my valuation model, we can see we're expecting free cash outflow of 4% in 2021 before we become free cash flow positive. And we will reach free cash flows as a percentage of revenue of 25% in 2025, where it will just start to sort of stabilize. So I've used 25% as their sort of optimum or their maximum sort of free cash flow as a percentage of revenue, because I've looked at other sort of businesses within this industry in the social media space, and they tend to earn anywhere between 25 and 30%. So Facebook, for example, have free cash flow as a percentage of revenues of 27%, and that's been fairly consistent. And so I think that once Snapchat does mature, 25% is probably a fair assumption. Now, of course, valuing a business like Snapchat, which is a high growth business, which is currently loss making, is inherently harder than analyzing a business which has been stable for many years, just because it's harder to forecast and see into the future. But these are the sort of assumptions that you need to make in order to come up with a reasonable valuation. And I don't think that any of these sort of assumptions that I've been making so far are unreasonable. Anyway, for terminal growth, we've gone for 2%, and then weighted average cost of capital is calculated at 9.6%. So then that brings us on to our valuation for the company. So as per the discounted cash flow model, we get an intrinsic value of $45 per share. And then as per the earnings multiple model, we're expecting their earnings in 10 years' time to be around 10 or just under $11 billion per year. And their expected PE ratio in 10 years' time to be around 20, which is probably fair for a company which at that time will be a fairly stable company. We get a price per share in 10 years' time of $137. And if we discount that back to today using the weighted average cost of capital, we get a average price of, or a price of $55. And when we take the average of the two, we get an average estimated intrinsic value of $50, which would provide you a negative margin of safety of 36%, according to the inputs that we've used in this valuation. Now, although a negative 36% margin of safety sounds very drastic, and I certainly wouldn't invest in a business that has a negative margin of safety of 36%, but we only have to go back to May when the company was actually trading at this valuation. So it's not so absurd to think that it could be a fair valuation for the business. And if we even go back a little bit further and go back to September, for example, 2020, $23.50 per share is what this company was trading at. So the only thing that I would say with this is be careful in terms of this significant run-up that they have seen. So for a company to increase by 240% in a single year doesn't necessarily mean that it's not warranted, but what we often will see following a run-up like that is a significant pullback. So honestly speaking, I wouldn't be surprised if this company just trades sideways for maybe a couple of years, or if it continues to run up and then later on we see a significant decline. But I'm honestly not sure that it deserves to be at a $78 valuation or a $122 billion market capitalization in the current performance that it's showing. So that's just my assumptions anyway. If you was to have a play around with the valuation model, and if you think that any of the growth rates are too conservative, for example, or the margins are too conservative, then of course you would come up with a different valuation. But that's the whole point of investing. Everybody has their different inputs and everybody has their different ideas. Hopefully you've enjoyed the video, guys, and until next time, thank you.